For the first time in a long while, silver is entering a phase the mainstream is completely missing. Not because nothing is happening, but because everything important is happening quietly. While headlines scream about stocks, crypto, and geopolitics, silver is slipping out of public focus. And historically, that is when silver becomes most dangerous in a good way. Silver is not just a metal. It is money, energy, and industry combined into one asset. Unlike gold, silver is consumed, used in solar panels, electric vehicles, medical equipment, military technology, and high-end electronics. Once used, much of it is gone forever. And here is the critical shift most people don't understand. Global industrial demand for silver is increasing, while accessible above-ground supply is not. This creates a structural imbalance. On paper, silver looks stable, but in the physical world, inventories are tightening. Dealers are reporting delays. Premiums are rising quietly. Large buyers are no longer negotiating price. They're negotiating delivery. This is not hype. This is mechanics. Silver has always moved in two phases. First, silence. Then, violence. The silence fools people into thinking nothing is happening. The violence arrives when positioning is already complete. Historically, silver never leads headlines. It shocks them. In previous cycles, silver lagged behind gold, then suddenly outperformed everything. Not gradually. Suddenly. And right now, silver is once again lagging, not because it's weak, but because it's being absorbed. Paper markets can suppress price temporarily, but physical scarcity always wins eventually. This is the core mistake most investors make. They track price instead of pressure. Pressure is building. Industrial demand doesn't care about speculation. Governments don't care about charts. Manufacturers don't wait for pullbacks. They secure supply. And when supply tightens, price follows violently. Silver doesn't move every year, but when it does, it compresses decades of movement into months. The quiet you see today is not comfort. It is compression, and compression always resolves. Have you ever wondered about the difference between holding a silver coin in your hand and owning paper silver? Let's break it down. Paper, silver, like ETFs or futures contracts, are financial instruments that represent silver. They're easy to trade, but you don't actually own the physical metal. It's essentially a promise of silver. Now, physical silver is the real deal coins. Bars, the stuff you can actually touch. Lately, there's been a huge surge in demand for physical silver, while the paper market sees massive trading volumes. This creates a fascinating situation. Some experts believe the massive volume of paper-silver trading far exceeds the actual physical silver available. This growing pressure could mean big things for the silver market. What do you think will happen when more people want to hold the real thing? Let me know in the comments. And don't forget to subscribe for more insights. Did you know that the device you're watching this on right now probably contains silver? It's not just for jewelry or old coins anymore. Global push for solar energy means the demand for silver is absolutely skyrocketing. All of these innovations are hungry for silver. It's a fundamental building block of modern progress. Thanks for tuning in. If you found this interesting, hit that like button and subscribe for more insights into the materials that shape our world. See you next time. Now, let's talk about the force that is quietly changing silver forever. Industrial demand. Silver is no longer just an investment metal. It is a strategic industrial resource. Every modern economy now depends on silver more than at any point in history. The green energy transition alone is rewriting silver's supply-demand equation. Solar panels require silver for conductivity. There is no cheaper metal that performs the same function as efficiently. As governments push renewable energy mandates, solar production continues to accelerate. Each new panel consumes silver permanently. Electric vehicles tell a similar story. An electric car uses significantly more silver than a traditional vehicle. From power management systems to battery controls, silver is everywhere. Now multiply this demand across millions of vehicles, then add data centers, 5G infrastructure, artificial intelligence, hardware, medical technology, and military systems. Silver is essential to all of it. This demand is structural. It is not speculative. It does not disappear when prices fluctuate. Industries do not stop production because silver becomes expensive. They secure supply, and this is the key difference between silver and most assets. When stocks rise, demand can cool. When crypto rises, speculation can reverse. But when silver demand rises in industry, it locks in long-term consumption. Supply, however, is not keeping up. Silver mining growth is slow. Environmental regulations, geopolitical risk, and declining ore grades are limiting new supply. Most silver comes as a byproduct of mining other metals. That means silver supply does not respond quickly to higher prices. Even if silver doubles in price, mining output does not double. This creates a structural trap. Demand keeps rising. Supply stays constrained. Historically, markets tolerate imbalance for a while. Suddenly they don't. When industrial buyers compete with investors for limited physical silver, price discovery becomes chaotic. That's when silver breaks free from paper suppression. This has happened before. In past cycles, industrial demand quietly built pressure for years. Then silver exploded in a short time window. Not because investors suddenly became smarter, but because reality finally overwhelmed the system. The same setup is forming again, and this time demand is larger, supply is tighter, and the global system is more fragile. Silver is no longer optional for modern technology. It is foundational, and foundational resources do not stay undervalued forever. To understand where silver may be heading, we need to look at where it has been before. Silver's most powerful moves in history did not start with headlines. They started with neglect. In the late 1970s, silver was ignored for years. Then, in a very short time, it surged dramatically, shocking markets and investors alike. In the early 2000s, silver traded quietly while gold gained attention. Then, as global liquidity expanded, silver outperformed nearly every major asset. Between 2008 and 2011, after years of consolidation, silver exploded upward. The move wasn't gradual. It was fast, emotional, and volatile. Each time, the pattern was the same. Long periods of sideways movement, low public interest, rising industrial demand, tightening physical supply, and then acceleration. Silver is unique because it is both monetary and industrial. That dual role creates extreme volatility when demand shifts. Gold moves first. Silver follows slowly, then silver overshoots. This is not theory, it is history. Every time silver wakes up, it moves further and faster than expected. Paper markets attempt to control volatility. They work until they don't. Once physical demand overwhelms paper supply, price no longer behaves politely. It gaps, it spikes, it shocks. This is why silver has always been feared by large financial institutions. It exposes the limits of leverage and synthetic supply. History shows us another important lesson. Silver moves are short-lived but powerful. Most people miss them not because they are late, but because they are early, get bored, and leave. Patience is required. Conviction is required. Silver does not reward constant trading. It rewards waiting. When the move begins, there is very little time to react. And when it ends, it leaves disbelief behind. The setup we see today echoes those historical moments. Not perfectly, but closely enough to matter. History does not repeat exactly, but it often rhymes, and silver's rhyme is getting louder. So the question now is not whether silver matters. It is how you respond to what is coming. Markets do not move to reward the loudest voices. They move to reward preparation. Silver is entering a phase where patience becomes a competitive advantage. Not excitement, not predictions. Patience. This is not about timing the exact top or bottom. It's about understanding structure. When demand becomes structural and supply remains constrained, price discovery eventually forces reality into the system. That moment does not arrive with warning. It arrives with speed. Most people wait for confirmation. By the time confirmation arrives, the opportunity has already passed. Smart participants prepare during uncertainty, not during headlines. Silver rewards those who think in years, not days. Those who understand cycles, not candles. This does not mean reckless buying. It means disciplined positioning, risk management, and education. Silver is volatile. It always has been. That volatility is not a flaw. It is the opportunity. But volatility only benefits those who are prepared for it. History shows us something very clear. When silver finally moves, it does not ask for permission. It moves fast, it moves hard, and it leaves very little time for second chances. The quiet you see today is not stability, it is tension. And tension always resolves. Whether silver becomes one of the defining assets of the coming decade will depend on the same forces we've discussed. Industrial demand, supply constraints, and monetary instability. Those forces are not temporary. They are structural, and structural forces do not fade quietly. If you've watched this far, you now understand more about silver than most market participants ever will. Stay informed, stay patient, and, above all, stay prepared, because when silver finally speaks, it will not whisper.